Moving over to section 5, what we call trend analysis and trend change checklist. 5-2. We had a basic trend analysis checklist that we used as guidelines, where we had the uptrends, the 5-point checklist we went through so far, which I said if we had stopped even at that point, you would have been in a position to analyze a trend, identify a trend change, monitor a trend, price target, and manage a trade to where when the trade started to move or the trend change started to take place, you were able to position yourself and stay in the direction of that trend until it was over. I had said at that point, as long as you could say yes, if you thought it was in an uptrend, if you could say yes to all 5 points on the uptrend side, the 80-40 range, the top-bottom support, the bearish divergence, the positive reversals, and then basically your basic technical analysis guideline of higher highs, higher lows. We had added the concept of the spikes, which we'll get into, but using that basic trend analysis guideline, those 5 points for the uptrends and the 5 points for the downtrends, 60-20, bottom top resistance, bullish divergence, negative reversals, lower highs, lower lows. They're the first 5 that I look at every time I look at a chart. Because even doing your charts by hand, you can follow that 5-point list. Doesn't incorporate on this list the moving averages, which you're going to let your computer do, but this basic 5 will keep you in focus and in tune with the trend. Taking the next section there, range analysis, uptrends, downtrends, left-hand side, bull or uptrend range is your 80-40 range. Many people, when they first start using RSI, trying to sell divergence, will sell divergence everywhere. Every time they see a divergence, they add to it, which is fine if the market breaks, but if it doesn't break and you continue to get higher and higher divergences, you're building a disaster. But when you see the RSI, now these are based on the 14-period RSI, when you see the range of 75 to 80, you should be looking for momentum highs in the RSI on a short-term or an intermediate or long-term basis, to where we see the RSI shoot way up to the 80 level, and maybe a month or so later we see it up at the 75 level. It's just making momentum highs. The prices are probably still working higher. You may see a divergence where the momentum high is at 80, followed by 3 or 4 periods later by a divergence point where you have that higher close, lower RSI, and it may show up at the 80 level, or you may see a 5-period signal show up at the 75, 77 level. It's just really a short-term momentum overextension. Your more important trend changes and divergences tend to occur around 70. And this next range down 70 to 75, you will see divergences from maybe where your X point is at 75 and your divergent point shows up at 70. You may see momentum highs where the RSI runs up to 74 and then runs up to 72, creating a divergence and sells off and then comes back up to 75. But it still stays above the 70 level. They're just short-term momentum pushes in price to where the momentum is still continuing to make higher highs with price. Swing failures in RSI momentum can be where the RSI rallies up above 70 and turns around and sells off a little bit, comes back up and fails to make a divergent point does not really go and close at a higher close. It fails to make that higher close. You can fail. We saw examples to where you get a momentum high and then the RSI sells off, and when it comes back up, it doesn't achieve that same price close on a closing basis. It may achieve it, as I said before, intraday, but by the close sells off. It's starting to show that the momentum is really failing, and even though the RSI continues to try and rally up there intraday, if you were to calculate the intraday high, you might have a divergence, but it doesn't close there. When you start to see that, it's a sign that the thing has a lot of weakness coming in because people are recognizing that things may be changing and they're starting to sell it. RSI moving average crossovers, I have there number 4 under the 70 to 75 range. If the RSI can get up to 80, and we're talking in an uptrend here, of a range of 80-40 being in an uptrend, it makes sense that if a simple moving average 9 got up over 70, up into the 75 range, that the moving average is now showing that it's approaching intermediate to long term because we've smoothed out the RSI values with the moving average. So when you see the moving average 9 get up above 70, you're approaching more intermediate to longer term overbought conditions. When you see it cross over and cross back down, the 9 dropping back down through the 45, maybe the 45 is at the 65, possibly even the 70 level. I've seen them to where the momentum has been so strong that the 9 has been above 75, the 9-period moving average has been above an RSI of 75, the 45-day moving average has been above 70. And it's hard to believe, but the thing is, when you have markets like we had before with gold and silver, or something that is extremely strong. We haven't seen the moving averages on bonds, even when they got to 122 and the 120, we never saw the 45 up over 70. But the 9 can get up there, and when it does, it's usually an indication that the intermediate trend is very, very overextended. The 60 to 70 level, number 1, divergence. You may see an X point or momentum high up around 68, and then a divergent point for a simple 2 to 5 period signal will be around 65. We showed examples of the positive reversals that sometimes take place and develop at the 60 level, where I say the market is extremely strong because any pullback whatsoever is being well supported. Top-bottom positives, maybe we had a divergence that showed up where the momentum high was above 70 or above 75, and then created a divergence above 75, but when it sold off into this area of 60 to 70, but it sold off right back to what had been previous tops. So you start seeing top bottoms and top bottom positive reversals. Number 4, moving average crossovers. We showed examples of the hidden signals to where the 9-period moving average on RSI had crossed the 45 to the downside, crossed down below the 45 prior to or just as a divergence was being created. 50 to 60, if you start to see divergences at the 55 and 60 level, like some of the examples we had marked in the book, you get a bearish divergence at the 55 or 60 level, it's usually a market that has lost so much momentum that it's trying to gain a foothold to get back to the upside, but there's a lot of selling pressure coming in, creating a divergence. So it's one to watch for in terms of a possible trend change or just prior to a negative. Because if you got a divergence at the, say, 58 and 60 level, the market sold off, and 2 or 3 weeks later, or even 8 to 10 days trading later, if the market had rallied back up, the RSI rallied up and kicked in a negative, it would probably be near that 60 level. Top-bottom support will show up there, top-bottom positive reversals. Intermediate, number 4, intermediate positive reversal support. In a strong uptrending market, when the market sells off, the RSI sells off, instead of coming back sometimes to the 40 level, it'll only come back to 50. If you look at the Japanese yen earlier this year, it was only selling back off to the 50 level and turning back up again. It never got back to the 40. So when you see positive reversal support and top-bottom support coming in at the 50 level on the RSI, then you know you've got a longer-term uptrend that's got a lot of momentum behind it. 35 to 45, we saw examples of what was overbought in that Eurodollar chart becoming oversold. We saw a lot of positive reversals coming off a bottom when they sold off both short-term and intermediate-term positives. And number 4 there, intermediate to long-term positive reversals. As long as you're seeing that 40, I say 80 to 40 is a range rule, but that 40 is not chiseled in stone. But I'd say 7 out of 10 times the 40 level will hold it. But when you see it selling off even to 35, especially if it's like number 3 there, top bottom positive, or number 1, an overbought becoming an oversold. Now let's take a look at the bear or downtrend range. If a market's been in a downtrend, when you get down to this 20 and 25, this relates to that question people said about the trend changes. Where do they, are they better at the 70 level, or what do we do at the 80 level? If a market's in a strong downtrend, and we're using a 60-20 range, when you reach the level down around 25 to 20, the market is generally going to be sold out. If it's going to be sold out, you should expect to see bounces. You may see some short-term divergences develop. You may see spike lows where it's trying to make the bottom and probing along the bottom, but prices can be building either like a base in price action, but the RSI keeps building minor little divergences at the bottom, or you will make a momentum low which will develop into a 2 to 5 period bullish divergence and a rally from maybe the 22 level back up to 40, and then come down to like the 25 level, then go back up to the 40 level, and come down to the 30 level, where each bottom is a little bit higher than the bottom before. If you start to see that, then you have what we call a rising type bottom formation, to where each probe to new lows by price is making a higher bottom. It's a longer term divergence. I think we saw it in sugar, to where we made a momentum low, and then an intermediate type divergence, and then a 2 to 5 at the 25 level, and then a rally, and then a pullback, and another divergence at the 30 level. The gold market did it earlier this year. We had an example in there where it had made a bottom, and it kept trying to go to new lows, but was not going to new lows, and it kept trying to build divergence at the bottom, and each divergence rallied a little bit, but then came back off. Number 2, the divergence long-term and intermediate, like in the terms of a rising bottom, or divergence points where you had a momentum low 1 month, and 3 months later you had a slightly higher RSI value, and then maybe another month after that another high, but you never really got divergences, but it's trying to build the base to where each level is less and less. Complex divergences develop down around the 20 level, 20 to 25, to where you get momentum lows, maybe a 3-5 period signal, a rally, another divergence, and a quick sharp rally, and then a pullback into another divergence. Or you will get divergences where you might get a 2 to 5 period signal, and then a quick rally into a negative, and then back down, and another divergent point, and another rally into a negative. Or you'll get a complex pattern like we had talked about, where you get both bullish divergence and negative reversals. But this is all taking place below the 30 level. The 30 to 35 is usually a good area if you start to see divergence on a long-term basis, and then you start to see some simple divergences developing around the 30-32 level. If your moving averages are down far enough to where they're starting to flatten out and turn back up, then you might want to keep a good eye on whether or not you're going to get a 2 to 5 whether you're going to get a 2 to 5 to where the moving averages have already turned up and the RSI goes down one more time and creates another 2 to 5, or 2 to 5 maybe at the 32 to 34 level. You might see swing failures in RSI to where you see the momentum low with a price low, a rally for a day or two, and then the next day the market sells off sharply below the close where your X point was. The closing price is below the same close that you had at your X, but it doesn't close down there. People start buying at that price level. They're starting to say maybe it is trying to bottom, and you never really get a divergence established. You don't really get a strong bullish divergence. But every time it goes down there and goes below what your X point was in terms of price, it comes back up by the close. RSI moving average crossovers, maybe the 9 gets down near the 30 and the 45 is down to maybe a 35, and then the RSI starts to turn up, the moving average turns up, and the 9 crosses above the 45 in the area of 30 to 35 RSI level, to where as it starts to turn up, maybe you're developing a divergence, maybe you're making momentum low, which leads to one of the hidden signals we had talked about. 30 to 40, you can get divergences, the simple 2 to 5 period, and maybe you made a 0.2 positive reversal, maybe you made a momentum low, had a rally, and on the pullback created some support to where it found support, either top-bottom support from the first rally off the momentum low, then rallied back up and then pulled back to maybe a 38 and created a positive reversal, which would confirm your bullish divergence. Or you will get your RSI moving average crossovers again. Sometimes if a market's been building a base, and as it starts to turn up, the moving averages start to turn up, the 9 crosses to 45, preceding which should be a positive reversal, and then you get another pullback in RSI that finds support at the 45-day before it turns higher. 40 to 50, I have seen divergences show up at the 40. We saw examples of them here in the pattern recognition section. But you will see bottom-top resistance start to form on rally attempts from momentum lows, to where all it does is rally up into what was a previous X point or a previous bottom-top resistance point. You will see bottom-top negatives at the 40 to 50 level. If a market is extremely negative, you will see intermediate negative reversal resistance. You also see what I consider like intermediate bottom-top resistance. You start looking when a market is at a bottom, the RSI is down in the lower part of the chart. Watch where the rallies go in terms not only of RSI, but watch the previous bottoms for bottom-top resistance, and also to see whether or not the previous momentum lows in price are still capping any rally, because then it means your trend is still down. 55 to 60, if you see the RSI starts to rally up, gets up near 55, but the price level when it reaches that 55 on RSI is less than what the price levels were when it was making momentum lows below 30. What was oversold before is becoming overbought. What were bottoms becoming tops, and it's more longer term. But you get your negative reversals to form in that range. You will see bottom-top negative reversals form in that range. And you will also see intermediate to long-term negative reversal resistance form in that range. But these are some guidelines that I like to share with people because of the fact that it will be very helpful, I think, for you in your analysis to take note of where the RSI is, what level it's trading at, where the moving averages are, the type of patterns you're seeing, and it will help you to identify the strength of the signal. Your chart 5-3, 5-3, we have an uptrends, letter A, downtrends, letter B. We had a basic 5-point checklist that we put together before, or completed before we went into the pattern recognition section. But after going through pattern recognition and introducing overbought, oversold, and also the trend analysis using the moving averages, we can expand our basic 5-point checklist to a 10-point checklist. With your uptrends, let's start at the top. With your uptrends, when a market's in an uptrend, we had talked about what is resistance becomes support. So every time it breaks a resistance level, when it pulls back and corrects as the traders are taking profits on their longs, the market sells off a bit. But normally what was resistance becomes support. And then we will rally to new highs in both price and momentum and make momentum highs, which is the basis for number 2, our bearish divergence. We'll see the momentum highs, which will evolve into bearish divergence points. And the market will sell off and it'll create positive reversals and start forming positive reversals. Then we start seeing number 4, higher tops, higher bottoms. And on the pullbacks that we see, we usually find support at the 80-40 range, or excuse me, at the 40 range. So we see support coming in there, and then rallies and pullbacks into what were previous tops becoming positive reversals. And number 7, spike lows, because whenever there's a sell-off in an uptrend, it's usually sharp and quick, and everybody turns extremely negative. It forms the positives and then turns up. So we get these spike lows. And this is pretty much the order in which you should see it, 1 through 7. Number 8 and number 9 I include because they are the ones that we're using for trend analysis. But when you look at a chart, you will see the top-bottom support. When a market first comes off the bottom, it rallies, pulls back, rallies, breaks resistance, pulls back into the previous top. Then maybe set up a bearish divergence followed by a positive reversal. Then you get your positive reversal and your bearish divergence, which are your 2 key points on your basic trend list or trend analysis list. The moving averages on close and RSI we use to confirm it. And you start seeing evidence of, on a longer term basis, number 10, the overboughts becoming oversolds. My favorite going through the list, though, is still the moving averages on close and RSI for trend analysis, and trying to focus on the positive reversals and the top-bottom positive reversals. But that number 10 I include because that's more of the intermediate to longer term perspective. They are your major moves. When you see the RSI running and price running to the upside and it hits a point where it makes a momentum high and sells off, when it sells off into a level that had been a previous resistance level, sure, it's a top-bottom support level, but more importantly, if it's like number 10, if it had been up around the 70 level and it sold off and came back down to the 40 or the 35 level, and the prices were the same like we did with the euro-dollar chart that we had an example of, then you're seeing not only previous price levels becoming support, but previous overboughts becoming oversold. And there's strong intermediate to long-term signals. Section B, downtrends. If a market's in a downtrend, the price will peak out. And after the peak, after a rally in price, sell off and attempt another rally, but it starts running into previous resistance. What was support is becoming resistance, so what was a bottom is becoming a top. It sells off again and maybe creates a creates a bullish divergence. And after we create a bullish divergence, we start a little rally. Well, if the rally turns out and forms a negative reversal, you've got bearish divergence and negative reversal showing, saying the trend is still down. You start seeing lower tops and lower bottoms in price. You see evidence of this 60-20 range. And then you get a rallies into what was a previous bottom. You start seeing bottom-top reversals, bottom-top negative reversals. And some of these rallies seem to come out of nowhere, but all they do is rally and spike up and turn into either bottom top or negative reversals. 8 and 9, the closing price moving averages and the RSI moving averages both stay negative. And then what was an oversold level or a previous bottom or a momentum low on from earlier becomes an overbought level. The market may rally up to or just shy of a price that had been a momentum low, down at maybe the 30 or the 25 level, but now it's showing up at the 60 level, and it's also showing up as an intermediate type negative, and may even rally up into a declining 45 period moving average. So we expand the 5-point checklist from the basic 5 to the 10 to incorporate this so that you have this to refer back to when you're analyzing charts, number one, and also so that when you're trading, you're aware of what different patterns you'll see and pretty much in what order you should see them. So when I look at a checklist, this is the one that I like to look at when I'm looking at a chart. And I think if you take this 10-point checklist, now that you have it, and you go back through the pattern recognition section, you will see how these things evolve and in which order they come. And it'll help you to identify the stronger signals from those that are probably very good signals but not as dynamic or powerful as the others. It will also help you to identify the ones that you probably want to spend more time with, because it may be one of those type trades that we talk about should be a money trade or a managed trade, to where you stay positioned in the direction of that trend. Start off by buying 1 or 2 contracts. If you see a bearish divergence, take a profit on one, let it pull back into a positive. Figure out where your price cycles are. When it pulls back into that positive, add the position back on that you took off initially, but maybe buy another one. And then when it goes up, sell out of those 2, let it pull back. But all the while leave one on, so that if you miss a trading opportunity where it doesn't pull back the next day like you think it will, and it takes off, you at least have that one on in the direction of the major trend. Chart 5.4 is a chart I originally put together to explain to a client how the RSI moved. And when I had finished, I realized I had 26 points on it, so I called it the ABCs of RSI. I think up to this point, through the basic course, we've gone through what I consider to be the ABCs. The other thing that we will go through in the last section is bringing in some related studies, but up until this point we have looked primarily just at RSI itself. And the way the chart is set up, each important point in terms of either a momentum high or a momentum low is set with a number and a letter. And I think if you follow along and take a look at it, we're not going to go through it now, but if you take a look at it and just follow the different points and use the price cycles, ranges that we talked about, the different patterns like A and C are a bullish divergence, and the rally to D is greater than the price was at C, and do your 50% retracements and your range rules or your price cycle rules, it'll help you to get in tune with practicing how to evaluate your charts. Just 2 points I'm going to make what I refer to as smiles and frowns. E and G, I and K turn out to be positives. And put the little semicircle in there with the little smile, the happy face, because people do like positive reversals. Because as long as you're seeing positive reversals, everything's right with the world, the market's going to nudge up a few points every day, and everything's wonderful. R and T, V and X turn out to be negatives, and they look like little frowns. So we call positive and negatives, kidding around sometimes, smiles and frowns, because of the fact that most people, as I said earlier, are by nature bullish. They understand the buy side, they don't necessarily understand the sell side, and I have met people over the years who will not sell. I don't care how negative a chart looks. If I tell them to sell, they won't sell. It may be a particular stock, which is being, if I say sell a particular stock and they say it's un-American to sell that issue, I say, well, fine, turn the chart upside down. I don't care. But it's a little chart I think would be a good help for you as a study. And it's interesting how it worked out. I just happened to be discussing positive and negatives and bull and bears and range and everything else with someone and put this chart together, and I thought I'd just include it for the rest of the class. 5.5 is, I had put this together for a lecture I did for CompuTrack, and it basically covers what we went through in terms of technical studies up to this point, but it's there in the event you want to put it in your computer as far as RSI, the closing price, the moving averages on RSI, the moving averages on close, the RSI 3 period, which is the only really short-term period I use, and then the moving average on the SMA 3 would be the simple moving average on the RSI 3. And lastly, that momentum 20, which again is the simple momentum. V minus Vx, today's close minus the close X number of days ago, which is really just going to measure the rate at which prices are going up or down, and whether it's above or below the zero level. This pretty much concludes the trend analysis checklist, but I put it in here in a separate section so that as you go through your charts, you will be able to refer back to it, the range analysis, the 10-point checklist, and be able to learn from it and see how it applies, because the one on the checklist there on 5.3, I put that list together just the way I look at a chart. So I think if you look at charts and go right down that list, you'll see how it fits in. The basic 5-point, though, as we first went through it, the basic 5-point checklist is is your quick assessment of markets and what's going on. It doesn't include the moving averages. It doesn't include the spikes that the 10-point checklist does. But the basic 5-point checklist, every time you look at a chart, you should look at the 5-point checklist that you see there on 5.2. And if you can say yes to all 5 for the uptrend sign, or yes to all 5 of the downtrend, then you need to take that particular stock, that particular futures market or whatever, and do some homework on it, because something's getting ready to start. And as you're doing your homework, you will see whether or not you can say yes to all 10 questions on your 10-point checklist. So this will conclude this section, and we'll pick up with the next section on related studies on the next tape.